Okay, hello everybody. Welcome to Karina Lanto Mentorship. So, you know what's really crazy is that I've been doing so many of these velocity banking demonstrations that in my head, it takes on average 7 to 8 years to pay off all your debts, including your mortgage. So, when one time when someone told me that she was going to pay off her mortgage or her rental property mortgage in about like 10 years, I was like, wait up, wait up, wait up. That's way too long, or it feels like it's way too long just because I've done so many of these demos, and usually, including the mortgage and the credit card debt and student auto loans, it takes about 7 to 8 years on average. And 10 years is kind of like on a bad day, you know what I'm saying? But I don't make any guarantees of how long it'll take, but that's just how my mind works now because I've done so many of these demonstrations. So, what we're going to do today is just another demonstration of debt payoff using something called velocity banking. And once you pay off that debt, then it's like a taste of financial freedom, right? And we're going to pay off our debt using something called a line of credit as our main operating account. And to do velocity banking, all it requires is two things, right? So, first thing is that you need a budget. Okay, so we have our budget and we have our income, expenses, our leftover savings for the month. Now, whenever we do an expense breakdown, it's important that we list all of our debts because every single debt is a hole in our cash flow bucket. And when this goes to zero, that's more cash flow for us to pay off all of our other debts, kind of like a rolling uh, snowball effect. Okay, and we also assume, right, we make the same income and we have zero savings, right? And so this is very hard for people to comprehend this zero savings. And I'm pretty sure there's spouses who kind of get into arguments about that because they freak out when they see this zero savings. Like, what am I going to do with my savings, right? In fact, it's really common when I get into, one-on-one Zoom chats with people. If they got a spouse, that spouse usually isn't on board because, like, they don't understand the strategy. And it doesn't mean that they're bad people. It's just that they don't understand strategy. Okay. So here what we're gonna do is we have our budget, same income, even though more income is great, zero savings, and we're gonna select a line of credit as our main operating account. Now, there are four different types of lines of credit that are available that you can use, right? The main ones are usually, if you're paying off personal debt, is either the home equity line of credit or the personal line of credit. Okay. There's also a business line of credit if you're doing this for a business, which is very similar to a personal line of credit, but it's in the name of your business. And then the last one is the credit cards, right? So credit cards, um, we might use as a last resort, or we might use it in conjunction with a personal or home equity line of credit. Okay. So let's just assume because we're a homeowner, we bought it right, right? And here's the thing about real estate, you make your money in the buy, right? Not when you sell. If you know how to buy it right, possibilities are endless. And let's just assume that we bought it before 2019. I know it seems ridiculous, but let's just assume that we did. So we bought it at 2019. So this is now like, I don't know, a $400,000 home, even though like when we bought it, I was like, it's just in the middle of nowhere. Why in the heck would this be $400,000? But when we are able to create something called equity, right, which is kind of like wealth out of thin air, banks will lend us money to use it, right? They'll lend us money just as long as we have the credit and the income to support that. And so let's say that we have a home equity line of credit for about maybe $30,000 for us to use. So an available limit of $30,000. So think of it kind of like a credit card based on the value of your home. Okay. And then we're going to use this as our main operating account. All right. So now what we got to do is just re-engineer our finances, right? Re-engineer them. And these are your typical debts: credit card, student loan, auto loan. Now, I know there are a lot of people out there with those buy now and pay later loans. I don't know what's the deal with those, but hey, I mean, you got credit cards, just use them. You don't, why take out another loan to eat up in your cash flow? You know what I'm saying? All right, so now let's go ahead and do this. We're going to re-engineer our finances, right? And I'm going to tell you the actual strategy. So the strategy is line of credit, I'm sorry, paycheck into line of credit and expenses out. That's all it is. So simple. And then our cash flow, which is going to be income minus expenses, will be used to pay down our debt. Okay, so now let's go ahead and do this. We're going to increase our cash flow by simply doing some debt transfers. So let's say I move this credit card debt, this three credit cards into our line of credit, right? And so this is going to be 25,000. 25,000. Okay? 25,000. And guess what happens here? This goes to 0, 0, 0, right? And now our cash flow just magically increased $700, right? That's $700 that we didn't think we had, that just came out of nowhere. It came out of our somewhere, that body part that people like to talk about when something comes out of nowhere, right? 2,176. And so now what we're going to do is just use our entire paycheck to pull down the balance of this line of credit and then take our expenses out, right? And the beauty of the home equity line of credit is that we can use it to pay anything. Because let's say we're using a credit card for this, we don't have that flexibility to pay other credit cards, or we can't pay a student loan or auto loan or a home loan with a credit card, right? Not possible. So now let's go ahead and see how long it takes to calculate the payoff of this home equity line of credit. And to calculate the next month's balance is just the previous month's balance plus the previous month's interest minus our cash flow. So our cash flow right here is 2176.69. Okay. So now that we have our next month's balance, we got to calculate the interest whenever we're using other people's money, where it's loans, credit cards, credit lines. We got to calculate the interest, and it's calculated by, on a credit line, it's calculated by the average daily balance, multiply it by the interest rate. So that's 10% here, and then divide by 12. Okay? And so now what we're going to do is we're just going to copy and paste this until we see like a red number here, which means it's completely paid off, right? That line of credit is completely paid off. Now I'm going to go ahead and highlight this. So a little bit after a year, we're $25,000 credit card debt free, right? So 25K in 13 months, debt free. Bam, bam, bam. Done, right? Now, it doesn't mean you can't use your credit cards, because credit cards are useful. And I'll tell you the one main advantage they have over the home equity line of credit or the personal line of credit. If you use a credit card, okay, and you pay the balance in full, you never accrue interest. Whereas with the home equity line of credit, you're always going to accrue interest when you use it, right? So that's like the main advantage of a credit card, and plus you get some bonus points. You never get bonus points for using a personal home equity line of credit. So when the time is right, use them both, right? If you know what I'm talking about, use to get the best of both worlds. Now, we have to focus on paying off all these other debts, right? So student loan, auto loan, home loan. Now you might be asking, which one do we focus on first, right? And it's been my experience that the home loan is always last. And so there's two ways of figuring out which debt to pay off or focus: lowest balance, highest interest rate, highest payment, or the debt that fits all these three criteria. Or if you're not interested, and here's the thing: the interest rate isn't the only that thing that determines the payoff. You could use a formula called the cash flow index, right? And think of it as a ranking system where the lower the number, that's the one you definitely want to pay off regardless of the interest rate. Okay? So let's go ahead and figure out, after 13 months, what's the current balance of these debts, okay? So student loans, when I used to do student loan calculations, it's been so long since I had a student loan, I forgot that they were for 10 years. But I was doing them in increments of 5 years, or 5-year amortizations. So let's go ahead and calculate this and figure out at 13 months what's the current balance. And again, this probably doesn't represent your situation, because these numbers are just numbers I pulled out of thin air. But let's say 22,000 at 3%, 5-year auto loan. So let's see, 22,000, 5-year, 3%, and 13 months. 17 grand. All right. And then home loan after 200,000 at 30 years at what percent? 5%. Oh boy, that's a low interest rate nowadays. Okay, so now let's figure out after 13 months what the balance is. So about 196K. Okay, good deal. Okay, so now let's just calculate that cash flow index. So what you do is you take the current balance on the right and then divide it by the monthly payment. So 31847.45 divided 354.36. This one is 17508.98 divided by 395.31. And then this one is, let's see, 196 796.66 divided by 1073.64, right? And so, like I said, you kind of think of this as a ranking system. The numbers have significance as well. So if it's like below 50, they tell you like pay it off, pay that one off, more than the ones that are above a 50. So as you can see, that home loan is always the highest one, and what it means is that like, would you pay 200,000 or $196,000 just to get $1,000 back, or $17,000 to get 395 back? You see what I'm saying? So that's why I say pay this one off first because you get more cash flow, regardless of the interest rate, right? All right. So now let's go ahead and focus on paying off the car loan first. Let me just do a quick calculation here. So luckily, when we're dealing with amortized loans, the calculation is a little bit tricky, but we do have a velocity banking calculator to help us with this, provided by Renatus. Now, full disclosure, I actually make money selling Renatus products, and I'm actually a student of theirs too. So Renatus is an education company where I originally learned velocity banking from in 2017, and they have this cool calculator. So if you want the calculator, you got to enroll in the classes, but people don't want to do that, but it's okay. All right, so now let's go ahead and do this. And oh, my screen went black, but let's go ahead and fill that in. So we're going to focus on paying off that auto loan first. Oh geez, did my screen go crazy? Let's go ahead and make this. Okay, so this is 22,000 is the original balance. Okay, 22,000 is the original balance, and then 17,508.98 is the current balance. Interest rate is 3%, 5 years, and what's the payment amount? 395.31. 395.31. Okay. Now, what's our income? Our income is 5,500, 5,500, and our expenses are everything except the loan we're trying to pay off, right? So it essentially would be these three. Okay. And then, so we're paying off this one, which is why it's not included. And let's go ahead and sum this up. D11 to D13. So 2,928 is our expenses. So kind of a big, our general expenses are kind of big, right? So, but we're making decent money. So 2,928 is our general expenses. So 2,928. Okay. And so now one thing I want to demonstrate is the difference between partial incremental payoff versus putting the whole thing in a line of credit, right? So let's assume that we put the entire balance into the line of credit, 17,508.98. So you could kind of see that even though the payoff is the same, the interest has essentially doubled, rather than just doing the incremental payoff or what they call chunking, right? And you kind of see that the interest kind of cuts itself in half, right? But it's still not that much. I mean, if you take a look at this, like you don't pay that much interest on a uh, car loan compared to, let's say, a 30-year mortgage. Okay, all right. But so let's go ahead and take this in our in our calculations about half a year, 6 months, and you can actually see the calculations happening here, right? So it'll tell you like, payment, interest, line of credit balance, and the interest that accrues, right? So, but let me go ahead and just write this right here because we're just going to focus on the number of months. So our auto loan is going to be 47K after our auto loan, and then 13 months plus 6 months is 19 months, right? So 19 months payoff. All right, cool. Now, what do we focus on? We're going to focus on that student loan because the student loan had the next lowest what's it called? Cash flow index. So let me go ahead and we'll take this out. This is now 0. All right, so now let's figure out what that student loan balance is at 19 months. Okay, so I just put this in here. So go to calculator.net for the amortization calculator, and then it's 35,000 for 10 years at 4%. And then this is going to be at 19 months, right? 19 months. 19 months, it's 30 grand. Okay, so this is the current balance. And we just plug in the information into that calculator, right? So now we put this in here. What's our current? Oh, whoops, that's not right. Okay, so 35,000, and then this is our current balance. Interest rate is 4%, 10 years, and then this is going to be 354.36. Okay. And then now we just got to decrease our expenses. So it's just these two now. So this is 2573.64. So 2573.64. Okay. So now we can see based on this payoff, right? It's going to take us about zero point 0.9 months or zero point 0.9 years. So that's pretty cool. So let's go ahead and add that. So what's 0.9 years? So 0.9 times 12, that's 10.8 10.8 months, right? Ignore the dollar sign. So we'll just say 11 months, right? So we'll just say 11 months. So 19 plus 11, that's 30 months. So 30, oopsie, I put it in the wrong place. Okay. So now this is 30 months, and now we gotta do 47 plus 35. So 47 plus 35, that equals 82K. So now what we're gonna do is put 82K right here. So that's gonna be 130 months is our payoff for that student loan, right? I hope I did it right. Did I do this right? Oh my goodness, I'm like freaking out because I don't know if I screwed up or not. So equals 0.99 times 12. So 11 months. Whoopsie, it's not 130 months, it's 30 months. All right. So, okay. So now we paid off 82,000 in 30 months, right? And now we only got the home loan to pay off. And a lot of people might say, "Hey, I'd rather just like invest," and that's cool too, because the home loan isn't taking that much of your cash flow. But let's just go ahead and do it anyways, right? Just because we're looking for that feeling of debt payoff. Oh my goodness, financial freedom, right? So now what we do is we got to figure out what the balance of the loan is at 30 months. Okay, so now so be was it 200,000 at 30 years, 5%, right? So now 107. Okay, so after 30 months, 30 months. All right, let's take a look here. 192. Okay, 192. Now we just put this all in our velocity banking calculator. Okay, so now 20000 0. Okay, and let me put that 196 here. And let me reload these because Excel's going a little crazy right now. Okay. All right, so let me go ahead and put this in here. 5%, 30 years. What's our payment amount? 1073.64. So 1073.64. And then now what we got to do is just take everything out except for that mortgage. And I think it's just 1500, right? So let's just verify quickly. 1500, right? So now if we take a look here, oh my goodness, 4.5 years, mind blown, right? So now what we do is just take 19 divided by 12 plus 4.5, and now we can see that to pay off 282K of debt, it's going to take us, holy crap, I just forgot the, I just forgot what number that I put in here. Oh, I swore too. I don't like swearing my channel, but oh well. Okay, so 4.5 years equals 19 divided by 12 plus 4.5. That's 6 years. Oh my goodness, 6.08 years. So 282K. So 282K, 6.08 years debt free. You see what I mean? So, like, when someone tells me their mortgage is going to take 10 years to pay off, I'm always a little bit skeptical because that feels like it's way too long. You know what I'm saying? Like, we had one, two, three, four, five debts that we paid off till we got to the home loan. And then this in total, including the home loan, took 6 years. So that's why, like, I'm confused when someone tells me, "Oh, it's going to take me 10 years to pay off my rental property using velocity banking," unless you grossly overpaid for this, right? Like, if you grossly overpaid for this, then that's no bueno, right? But this is why we always emphasize buying properties at a discount, because you don't want to like overpay for a California property that's costs $1 million and only gets you like $4,000 in rent. What you want is like a 200 no, a $300,000 property that you got $100,000 discount, and then use velocity banking to pay it off. That's what you want, right? And you're getting about $2,000 of rent. Okay, but that's things we emphasize in other classes and videos and all that. So we're not going to emphasize that right here, although we want to make sure that we do get the lowest price possible compared to the market value. All right, well, that's it for today, everybody. Let's go ahead and put this as 0. And now we got $4,000 of cash flow that's actually going to go into our savings account. And this is the appropriate time when we're going to have savings, not that fake savings we got when we got all this debt. All right, well, this is a Korean Atlanta mentorship. If you're interested in joining a group, go ahead and click the Google form link below. Other than that, have a great day, and we'll speak next time.